Hey folks, we are getting started in options trading. Then this video is for you because in this video we will understand about option jargons and which are very essential for you if you are trading in options. So let's start this video by understanding, first two not even jargons but two types of option. So first one is call option and the other one is put option. So call option gives you right but not an obligation to buy the underlying shares at a predetermined price. Okay, the put option, it gives you right to sell the underlying shares at a predetermined price. Okay, so two types of options. So let's make a note of it. So two types. First one is call option. Okay, or let's not write first. Call option. Okay, gives option buyer right to buy the underlying shares. Okay, whereas put option gives right to sell the underlying shares. Okay, so this is the first thing. Now, if you just see, this is the option chain in the app. So this is one of the most essential analytic, or this is the most essential data point for all the option traders out there. So if you want to access this tool, the link would be there in the description and also in the iCard over here. So now, if I just explain you what a call option is. So let's say I buy Reliance 2400 strike price call option. Okay. So now I have a right, but not an obligation to buy Reliance's shares on 27th of April, okay, at 2400. If I want to, I can. If I don't want to, I don't. Okay. Now let's say if Reliance's price goes to 2500, I have the option contract, right? I have my call option. I can go ahead and buy the Reliance's shares at 2400, and what that is what option is, right? And this is what makes things very interesting. Let's say something which is expensive in the market, by having a right but not an obligation, I can go ahead and easily participate in that trade. Another thing is, let's say if I buy Reliance's 2300 strike price call option, okay, and let's say if Reliance falls to 2200, now my option doesn't have any worth, right? It doesn't have any value, any profit along with it. So I can let go the premium in this case, right? My maximum loss in case of buying would be just the premium that I am paying. Okay, which brings us to the second jargon, which is premium. So amount paid by buyer, okay, and received by seller while initiating a option contract. Simple. Okay, nothing complex in that. Now moving ahead, we have more jargons such as American style options and European style options. So the difference is only such that in American style options, you can exercise those options anytime before the expiry as well. So, options, they are wasting asset. You can't buy an option and just hold it forever. At some day, it is going to expire. That means after that day, that option will not have any worth. That option will not, that will not hold any value. So, American style options, they allow you to exercise your contract, to honor your contract even before the expiry date. But in case of European style options, they can be only exercised on the expiry date itself. Okay, so that is the only difference in American style and European style options. Then there comes strike price. So strike price is nothing but exercise price.
Hey traders, Quantsapp has simplified option trading analytics for you. Click the link in the description box below, complete your sign up process and access the most advanced option analytical tools in the entire industry. Thank you.
Okay, so what is exercise price? So, this strikes, if you see in the option chain, it is clearly mentioned strikes. So what do I mean by strike in this case? At what price you will buy the shares of Reliance? At what price you are going to exercise your contract? At what price you are going to honor the contract? So in this scenario, if I buy, let's say Reliance's 2300 strike price call option, doesn't matter what the scenario is in the future. Okay, I have to buy, or I have the right to buy Reliance's shares at 2300 rupees. not a rupee here and there. Okay, I will have to buy the Reliance shares at 2,300 rupees. I have right for that. Let's say if I buy 2,400 strike price call option, that means I have a right to buy the shares at 2,400, not here and there. So that is strike price for us, exercise price for us. At what price we will buy? If it is buy slash sell the underlying. Okay. Then comes the open interest. Okay, OI, as referred or as known as OI, open interest. So open interest is nothing but total number of outstanding contracts of that option. How much options are open which have not been settled yet? Okay, it can be buyer or it can be seller, but how much contracts are open in the market which are not settled is shown to us by open interest. Okay, so contracts which are not settled. Okay, now open interest, it will give you more analytic rather than just knowing how much participants are participating. But open interest also shows you what the consensus, what are the majority of the participants thinking. So whenever we look at options data, we will look at it from writer's perspective, the options open interest data. And reason I'll tell you, because option seller is taking a negative reward to risk and still is selling. Number one, option seller is bringing in heavy margin, that still is selling. Number two, number three, option seller knows his profit is limited, still is selling. Number four, option seller knows that his losses are unlimited, still is selling. So when a option seller sells, he is, it is anticipated that he has done a well-researched approach and, his forecast might be correct. So, we analyze it, okay, in market. OI is analyzed from option writers POV, okay, which brings us highest put support, highest call resistance. Okay, so in Quantsapp, these data points are much more simpler. So all you need to do is just look at this. Okay, the biggest red bar. So on the put side, if you see the OI thing, it has been color filled, right? So the biggest red bar will act like a support. So where the Reliance's support is right now. So the Reliance's support right now is at 2,300. So 2,400. Why I'm saying 2,400? Because I see the highest call, the biggest green bar over here at 2,400. Okay, so this is how you looking at OI. You can easily go ahead and anticipate the trend. Then we have something named as delta. Okay, so what is delta? Rate in change in premium due to change in underlying. Okay, so it is very simple. It is showing you that how much your underlying is impacting your option premium. Okay, so let's say if this is the option 2380. So if Reliance moves up by 1 rupee, this option will move by 0.41 rupees positive. Okay, if Reliance goes down by 1 rupee, then this option will go down by 0.41 rupees negative, right? Similarly, on the right side, if you see the delta is negative for the put option, then it will act the same way. That means if it goes up, the Reliance stock price goes up by 1 rupee, the delta will show you in absolute rupees how much the premium will go up or down. So in this case, if the future price goes up of Reliance, then the put option have negative delta, so the put option premium will go down. Then we have something named as theta, one of the simplest things, time decay. How much premium will be decayed if you hold that option for 1 day? Okay. Then coming to Vega. What is Vega? Impact of IV on the option. Okay. How much implied volatility is going to impact your option premium? It is shown to us by Vega. And just be careful about this, that I have seen a lot of things wherein Vega is misinterpreted as implied volatility itself. So understand guys, Vega is not implied volatility, but it is impact of implied volatility on option. Okay, so it is not the implied volatility, it is the impact of implied volatility on the option. Last thing is gamma. Okay. So gamma is rate of change in delta. So this is second order derivative. Okay. So rate of change in delta. So it will tell you how fast the delta will move. Okay. So more the gamma, more fast the delta will move, less the gamma, less, or slowly the delta will move, and eventually more the gamma will lead to a faster move in premium, less the gamma, it will lead to a slow and steady move in the premium. Wakes up during expiry. And yes, folks, that was it from my side. Let me know in case if you want to know any other jargon of options trading. I have tried to, cover most of the things over here. One last thing is IV, which is implied volatility. So it is nothing but forecasted volatility according to the current option price. Okay. In simple words, it is nothing but uncertainty. Okay. So yes, folks, that was it from my side. In case if you want to know any other jargon, do let me know in the comment section below. Thank you so much. Bye bye. Take care and happy trading.